I'm Charlotte McLeod with investingnews.com, and here today with me is Jay Martin, CEO of VRIC Media and host of the Vancouver Resource Investment Conference. Thank you so much for being here. Great to have you.
I'm happy to be here, Charlotte. Looking forward to this.
So happy to have you back once again. We are heading into the end of 2025, into 2026. And of course, we know that the Vancouver Resource Investment Conference is coming right up in January. So we're going to get into that. But I thought we should start by setting the stage because so much is different and changed from the last time we spoke about a year ago, especially when it comes to gold. So I thought we could begin there and get your take on where we are in the cycle for gold after this historic year that we've had.
Yeah, that's the million-dollar question. And it's interesting, isn't it? Because depending on who you talk to in the sector, you'll hear from investors that think the industry is already getting too frothy, too hot, too much mainstream coverage, and all of this. And quite frankly, I chuckle a little bit, Charlotte, when I hear that, because what that really shows me is that it's been so long since the last good market in the gold sector that investors have quite literally forgotten what a good market feels like. And as soon as they see any mainstream financial media press coverage, they assume that means we're near a top. But obviously you can reflect on the cycle of any other asset that we've seen run over the last 10 years. And we're not even close. And in fact, in many of the generalist investor groups that I'm a part of, you'd be shocked at how infrequently, if at all, gold is even mentioned as an asset class that people should consider. You and I, being inside the circle, we're much more sensitive to that. And so we feel the industry heating up. We see the cash coming in, the share prices appreciating. But, one step outside of the immediate circle of precious metal investors, and it's still a conversation that hardly at all happens on the margins at best. And the way this gold market has rolled out has been incredibly textbook. It's been slow. It's been methodical. It's required a lot of patience from investors. Anybody who is looking at share prices today and thinking, oh, it's getting a little hot, it's moving a bit quickly, should just remember how impatient they felt in 2023 when central banks were buying up physical gold at record numbers and the physical price started to move, but the equities were flats and investors were complaining, what's wrong with the market? Why is the price of physical decoupled from the equity prices and all of this? And then towards the end of 2023, we saw the best-in-class royalty companies begin to catch a bid. And 6 months later, the best-in-class producers begin to catch a bid. And the whole way along, investors were complaining, how come the explorers aren't catching a bid yet? What's going on? Why is this? So if I were to step back and look at this from that time horizon, it's actually been very patient and methodical, which is great news because often market cycles, the down cycle reflects the up cycle. And so you want a very slow, patient, methodical trickle of capital into the sector. That's often reflected in the back half as well. So
great observations, I think, and a good reminder for everyone who is maybe feeling a little bit nervous right now. And it ties into a theme that I saw coming up. I was mentioning to you before we turned the camera on, I'm just back from the New Orleans Investment Conference. And one of the topics that was coming up there is concern around the mainstream attention gold is getting, people wondering, is this still a contrarian investment? Because people are so used to being on that side of the trade. So anything you would add there on the contrarian nature of gold at the moment?
Well, yeah, you look at that coverage and how the gold sector is being explained, and people are confusing this gold rally with just the next asset rally. And they're comparing it to any previous rally they participated in. Maybe that was AI, maybe that was crypto, whatever. And gold's just next in line. This is the next asset that we should get into and then out of. And that's why they're calling it the debasement trade. They've got the first part of that right, but the second part doesn't make sense because if you think about the mechanics of a trade, it means you have some cash, you trade that cash for an asset that's undervalued. Once that asset appreciates, you trade it back for cash. But the mission behind the debasement trade is that we're trading out of cash that is being debased into something that cannot be, being gold. Well, at what point in that process are those investors going to trade that non-debased asset back for the debased one? Like the second half of that trade won't materialize the way people are thinking about it now. And you can't fault them for thinking about gold that way because that's how investors have been conditioned. But as people will learn, the gold market's a little bit different. And a hot gold market isn't just the next asset rally. It's a smoke signal for some bigger tectonic shifts that are occurring. And we're watching those. And so I think the first half of the debasement trade, as people are qualifying it, is occurring. But midway through, they'll realize they had that a little bit wrong. They're not going to want to go back to the debased asset they traded out of. And they'll begin to understand the bigger shift happening in the marketplace that is led by the gold price.
Great point. That is a little bit of a misnomer there, at least in the second half of the phrase. And I'm wondering, so we know that gold is a long-term hold for most of the people I think that we're speaking to right now. But there is a lot of questions right now about the next trigger for the leg higher that will come next. And I'm wondering what you see, because there's, of course, so many drivers of gold right now to choose from.
Yeah, I think if you get back to kind of the bedrock foundation of this gold market, and recently, let's not go too far back, but say 2021, 2022, these are the preliminary buyers of physical and mass quantity, and they provide that foundation right now with which this market's being built on top of. And that's very slow, very patient, very long-term capital being central banks. It's important to understand the incentive for that transaction to have occurred. Central banks began buying gold because they were making two core assumptions. The first assumption was that the US dollar would continue to be devalued. And the second assumption was that US geopolitical strategy would be less predictable in the future than it was in the past. So unless those two assumptions are no longer true, the gold thesis from that standpoint is still intact. That will keep the gold price elevated, and that will continue to produce quality quarterly earnings for all the gold producers, which will mandate the biggest institutions in the world to have an allocation to this industry that is one of the only to be generating significant amounts of cash right now. And so it always takes a few quarters of earnings reports before Wall Street begins to develop mandates for increased exposure to an industry. And we're getting there now with the gold sector. And will continue to be, because a lot of the projects that we're watching today were put into production at $2,000 gold, $1,800 gold, and so we could knock $500, $1,000 off the gold price, and they're still more favorable than they were 6 years ago. I don't think that's going to happen, but the point is it takes, 3, 4, sometimes 5 quarters of earnings before major institutions are mandated to move in because their shareholders are demanding it. And so, that's another large, patient, long-term capital player that's just beginning to enter the sector right now and add some buoyancy to the equities.
Well, and talking a little bit more about how gold is going mainstream, people are waking up to how well the gold stocks are performing. We mentioned we're looking forward to VRIC in January. Do you have any early indications that maybe the crowd of people who are attending is going to be bigger, is changing in terms of the makeup of who will be there? Anything you're seeing at this point?
Last week, I had to rent an additional exhibit hall for the Vancouver Resource Investment Conference. So there's an indicator, and that's just an expression of new interest coming to our sector, right? My conference is a good gauge of investor sentiment because it's a retail investment conference, right? We will get around 8,000 investors there and lots of advisors, analysts, and institutional money. But the majority of my attendees are retail investors, Charlotte, folks like you and I who have a day job, but also invest some capital in the junior mining sector. And so when we see our audience begin to swell a little bit, that's an indication of sentiment. And our numbers forced that decision last week. And I was very opposed to it, by the way. I've really held the line at containing my conference to a very conservative size for the last few years because of how difficult the last 13 years in the business have been. And I don't want to overpromise any of our clientele and show attendees, but we couldn't ignore the numbers this year. Now, you could hear that and say, oh, that's another frothy signal. But just for context, we are still less than 50%, my conference, less than 50% the size that it was in 2010 and 2011. during the last bull market run, less than half the size still, even with this expansion. So we are seeing a lot of new capital come to the sector. It's great to see. It's well earned. And I think they're in a good place. I can feel really good about driving attendees to this conference this year because I have a lot more confidence in the management teams in the junior mining sector than I did in 2010 and 2011, right? That was a bit of a disastrous year to get into this industry. Right now is the exact opposite of that, right? We're becoming favorable. Political sentiment is shifting towards our industry, which we haven't seen in 12 years, both in the US and Canada. The political narrative is now supporting the extraction industries. The critical metals list in the US now has 60 metals on it, up from 35 in 2018. And so our industry is suddenly in favor politically, and that will continue to attract more capital because people want to invest where it's safe and supported. And it hasn't been mining for a long time, but that's coming back very quickly now.
Certainly, we're starting to see so many positive changes for gold and the mining industry in general. And I think it's important to note, though, so you mentioned this influx of people who are coming into the sector. And we've both heard, I think, many times when gold is doing well, that tells you that something not good is happening in the world. And you talked a little bit about this when you're speaking about drivers of gold, but maybe if you have any further thoughts on what gold is telling us about the world, what people who are coming to the conference, coming into the sector might be picking up on right now.
I think people understand that we're going through a massive tectonic shift geopolitically, and most people are having a hard time understanding that. And that's because it's a very complex thing to understand. What is clear is that my entire life has been an era of increased access to a wider variety of cheaper and cheaper goods. That was the era of globalization. And any company or any country, if you had the cash or the credit, you could buy whatever you wanted from whoever had it. That era is definitely over. What happens next will be a lot harder to predict. It's not going to be quick or simple, but it will be different. It's a reshuffling of the geopolitical chessboard. And all that means for commodity investors is that those same companies and countries that could previously buy whatever they wanted from whoever had it can no longer have that certainty. And that's why we're seeing an expansion of the critical metals list. Silver all of a sudden is on the critical metals list. That's because politicians can no longer be certain they can procure the supplies they need to build the economies they're mandated to build. Whether that's, military development, we're looking at delivery timelines from Lockheed Martin now consistently 2 to 5 years behind schedule. That's supply chain issues that are causing that. And so that's the big shift. And, this arrives in people's lives in different ways. Most commonly, it's through, consumer price inflation. They're just paying more for stuff and they're not sure why. But when they dig 1 or 2 levels beneath the surface, what they'll find is that supply chains are going to continue to be disrupted because the sort of collection of geopolitical allies and adversaries is shifting very quickly, and it's very hard to predict who's going to land where. And in an era of uncertainty, you're going to have to pay more for the things you want certainty over. And raw materials, the building blocks of everyday life, if it wasn't grown, it was mined, are sort of front and center in that. And so, I think that's why a lot of people are picking their head up, looking around and saying, what's going on out there? Regional conflicts, civil unrest, trade aggressions, all these sensational headlines. And a large percentage of those people end up turning their attention to the raw material sector because it's my core belief. If you dive beneath any of these hyperbolic headlines, what you'll find is the core motivations are supply and demand of raw materials. That's what's triggering all of this activity, whether it's trade aggressions or hot war conflicts, et cetera. So a big percent of people come to our sector for that reason.
Well, and I was going to ask you where you're seeing opportunity right now beyond gold and the precious metals. And it sounds like certainly critical minerals is on your list, but it gets tricky. I agree. Definitely they're coming to the fore. But as you mentioned, there's so many critical minerals now. We've got silver on the list in the US, many, many more. And I think it can make it difficult for people to approach, okay, I want to invest in critical minerals. Where do I go? So how do you go about sorting that out for yourself?
I think you have to get really clear on where you want to build a competitive advantage, and you can't be everywhere at once. And so I like to have most of my portfolio built around core theses that I have a lot of confidence in. So I am disproportionately exposed to copper, silver, and gold. And we can dive into those. But, I also think a metal like nickel is positioned incredibly well right now, because the market's been flooded with, I believe, an unsustainable supply of very cheap and very dirty nickel from Indonesia. And that's why the nickel price looks sort of opposite to every other hard commodity price that you might look at these days. It's a very unique situation, but that's not a sustainable situation. And this has created a lot of very cheap Australian and Canadian nickel companies. But it's a asset that you got to be very confident in sitting on for 3 to 5 years for that situation to turn around. Right now, Charlotte, honestly, given all the uncertainty in the world, I like things that are steadfast. And so I don't get into too many obscure metals because, a lot of the rare earth thesis, for example, rare earths aren't rare. We know this. They're very abundant in the Earth's crust. The choke point's actually the refinement, right? And so if you misunderstand this, why the supply is scarce, you'll probably make some poor judgment in your investment thesis. And so watching that sector, what you want to watch for is the refinement, not the supply and the mining. And these more obscure critical metals, the more obscure you get, what you're talking about is emerging technologies or advanced weaponry or, very specific magnet applications that are used. That's what these metals are used for. And any emerging tech, innovative tech is subject to pivots and re-engineering. And so the supply side of these metals is just a lot less certain. And so, the gambler in me likes to make some bets every now and then, but my core portfolio is like gold, silver, copper. I'm very strong there. I'm not as exposed to uranium, although I think it's a great bet. And that's just an example of I stick to what I can focus on every day. And I have a very big competitive advantage in gold, silver, copper because I obsess over those markets. We have tons of uranium exposure at my conference, but as a personal investor, I don't obsess over that industry as much as I feel like I would need to have that competitive advantage and invest capital aggressively.
Well, I think it's great advice to stick to what you know. It makes a lot of sense. And if we're talking about things that are steadfast, copper, I think certainly fits the bill. I'm wondering if you can talk a little bit more about what you see coming for copper and how you're approaching it. Because I've been hearing about copper as a good story for years now, and it has seemed like it has been in the long term. Maybe now, though, it's coming forward a little bit in terms of when we might start to see a little bit more activity in copper. So how are you looking at it?
There's two main convictions you'll hear on the copper sector in my experience. And the bull copper case would say we are about to see unprecedented demand for this metal on the heels of renewable energy, AI data centers. And this is going to put pressure on the copper price like we've never seen before, and demand's going to go through the roof. The bears would say, yes, probably, but in the meantime, we're probably facing a globally coordinated recession, and that's going to absolutely crush demand. So, those hopes and dreams they're just fallacy. They're not actually going to materialize inside of this decade. What I like about copper is that you can look at 50 years of supply and demand dynamics that will help you make sense of those two opposing points, which are probably both true. And what you'll see if you go back to copper supply and demand fundamentals from 1970 and go decade over decade, 1990, 1980, 1990, 2000, 2010, is you'll see that we've increased our copper demand by about 4 to 6 million metric tons every decade with remarkable consistency for the last 50 years. And why that's important is because over the last 50 years, we saw massive technology innovation and disruption. So anything we're forecasting in the future from a tech standpoint has happened in the past. The dawn of the internet, the personal computer, smartphones, like urbanization of China. We saw all this, right? That happened over the last 50 years. So whatever happens in the future, we can look at the past and say, well, it actually didn't cause tremendous spikes along the way. It was still very consistent. And to the downside as well, we may be faced with a globally coordinated recession in the near future, but guess what? We've had like 3 of those in the last 50 years. So we can look at that as well and say, despite those events, both to the upside and to the downside, our copper demand growth has been very consistent if you step back to a decade over decade approach, which I think is a smart take for an asset like copper. Now, the interesting part of the story is that supply actually met demand like right on the nose in 1970, 1980, 1990 2000, and then in 2010, a little gap began to open up that got very wide in 2015 and really began to broaden in 2020. And that's just a factor of us not reinvesting in new supply, beginning in the 2000s. And so that is now materializing in front of us. It takes about 10 to 20 years to get a copper mine online. We stopped investing in copper supply about 15 years ago, and now we're living in that reality. And it's going to take a few years for us to close that gap. So I'm very bullish on the copper sector, but I'm very clear on my time horizon. And so if anyone's rushing in thinking, I see the supply and demand gap, this is a no-brainer. It's a no-brainer eventually. That doesn't mean it's a no-brainer in 6 months. And people have to be very clear on that. So copper will do very well this decade, but there's going to be volatility along the way, but it's a very sure bet.
I agree. Time horizon, so important. And I wonder if briefly you can talk to me a little bit about what you see coming for silver, because of course it's a precious metal. It does have that steadfast angle, but it's known for its volatility. So how do you deal with that in your approach?
Silver is a complex one, right? Because you have many driving forces participating in that market, both industrial and monetary incentives to invest in silver. And then as a consequence of there being very few silver primary mines, the supply actually doesn't respond to price the way most commodities would, right? We're right now rushing to get new copper mines online because of the price. Gold producers the same because of the price. But most silver comes from gold mines. And so you can actually have that reactive nature. There's only like 9 silver companies on the NYSE. It's a very small market. And that's largely why it's so volatile. It's sort of the Me Too metal. When gold starts to run, silver investors look for leverage in the silver sector, and they get it because it's a much smaller industry. And so bets go a lot further to the upside and the downside. I think about it like this, Charlotte. The sure money is made in the gold sector, but the big money is made in the silver sector. And, that's proven true over the last couple precious metal cycles. I believe it'll be true in this one as well. But because of that volatility, it's definitely a smaller piece of my portfolio relative to my gold positions. More volatile, but that's where the big money is typically made.
I haven't heard it said quite like that before. I like how you phrase it there. All right. So these themes and more are going to be expressed on stage at VRIC in January. Is there anything you can share at this point about the lineup? Any highlights that you are really looking forward to?
I'm so excited for this year's event, Charlotte. It's we have about 120 keynote speakers coming out to the conference, 6 stages this year at the show surrounding our exhibition hall that'll have around 300 mining companies looking to tell their story and raise some money. So if you're looking to allocate capital to this sector, the reason you come to the VRIC is to sit in the front row, hear from dozens of capital allocators in the sector. Anybody on stage, we bring them out because they have a solid track record of allocating cash to the junior mining sector. And I want to know where they're putting their money in 2026. So that's what they talk about on the podium. We have a bunch of workshops, 5 workshop rooms where we get very specific into individual equities, what these investors are buying and why, and their thesis on a variety of metals. And then on our main stage, we cover the biggest macro and geopolitical themes that matter to commodity investors. And so you'll hear a wide array of, trade war conversations, geopolitical breakdowns and analysis. As long as it ties back to the supply and demand of raw materials, I want it covered at this conference. It truly is the Super Bowl for the mining sector. And VRICmedia.com for tickets. General admission, Charlotte, is actually free. If you just want to come, take a seat, talk to companies, you're our guest. You do have to register and, answer a couple questions, but you can get in the door, no problem. For anybody who wants extra access, you want to meet Robert Kiyosaki and give Rick Rule a high five or whatever, meet Nomi Prinz, Danielle DiMartino booth, grab a VIP ticket. It gets you guaranteed seating in the speaker hall, which will absolutely be full this year, but this will get you the best seats in the house and a guaranteed seat. Ticket to the keynote speakers reception, which is sort of a highlight of the event. On Sunday night after the conference, we have a little private gathering for all the keynote speakers. I hope to see you there. And our VIP ticket holders, where they can just kind of spill some wine and get to know each other in a more intimate and quiet setting. So that's a highlight for the VIP ticket holders for sure. But January 25, 26, I'm looking forward to it.
January 25th, 26th, we'll have all the details in the video description so people can find out more, hopefully sign up. I'm really looking forward to it. And I will let you go for now. I have one final fun question that I will ask before I let you go, which is looking forward to 2026. What would be your pick for the top performing commodity of the year?
2026 top performing commodity. I'm going to go with silver. If you're making me pick one, if that's what you're making me do, I'm going to go with silver.
If you want to add to it, feel free.
No, I'll play that game. That's fun. I think as mentioned earlier, the sure money is on gold, but the big money is on silver. And I think we're going to see that materialize in 2026. So if I had to pick one to go all in with the purpose of maximal return and accepting the risk, I'm going with silver.
Okay, well, perfect. Thank you so much for coming on to talk about the market, VRIC. Great to have you as always.
Thank you, Charlotte. Appreciate it.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Jay Martin.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.